It's so great to see everybody. I want to thank you all for joining us today for this great webinar with Laks, Michael, Joe, and we're really going to break down a lot of what people aren't telling us in private credit. A couple housekeeping issues before we get started. We're going to take Q&A on this as we go throughout, but the way we do the Q&A is in the bottom of the webinar panel. You'll see a way to submit questions to us. So as we're going and as you ask questions, please submit that, and then we'll address them as we go along, or definitely by the end that we kick this off with. Okay. So really, at the end of the day, thank you everyone for joining us. I'm really excited about the panel that we're able to have here, and I think what we're talking about is, if you've been told that you have money locked up in private credit, or you've ever even been pitched a private credit fund from one of the asset managers, right? Or more importantly, if you're staying invested in private credit right now and not trying to redeem, what does that all mean for you? And I think that's what exactly this webinar is really about here. So I just want to take 2 seconds because you may be familiar with one of us each, but I wanted to give everyone a chance around here to introduce themselves. So I want to kick it off. Laks, can you just tell us a little bit about yourself and your role you've been playing? Because I know you've been very vocal about this space.
Hi, Todd. Thanks for having me, and hi, everyone. I'm Laks Ganapathi. I run an independent investment research firm focused on short only. We've been following shadow banking, aka private credit, for more than 5 years passively, and it has gained momentum over the past year or so. Um, you can review most of our information in our newsletter. Todd, back to you.
Yeah, no, certainly. And what we'll do is we'll be sure to give everyone handles for social media and ways you can reach out to everyone if you have any questions afterwards as well. Many of you may be familiar with Michael, but I want to give him a chance to just talk about himself a little bit here as we kick this off.
Yes, and I promise not to bring my ex personality to the webinar. Appreciate everybody here that's here. Been in the business since really since I was a child, but I'm interested in listening to this conversation and participating in it. For the last year or so, I've been saying repeatedly on X that private credit is this cycle's subprime, and now that everybody believes that, that makes me think that there might be actually a buying opportunity, maybe as a trade. We'll talk about that, I'm sure. But manage several funds, including the free markets ETF with my friends and colleagues here, Todd and Joe, as well as Hal Lambert. Been very much an active tactical thinker. Have the lead lag report research as well as lead lag media on the agency side, working with 30 fund issuers, 300 financial advisors. So for whatever it's worth, if you happen to be a financial advisor, feel free to reach out to either of us, but in particular me, because I want to make sure that I keep on growing the network. So thanks everybody for joining.
And Joe, go ahead.
Yeah. As Michael said, Todd and I are partners with him in the free markets fund, FMKT. But Todd and I, along with our partner Steve and Julie, started SYKON Capital a number of years ago. It's a full stop wealth management firm. We do financial planning, so on and so forth. But private credit's an area where Todd and I, for I don't know, the better part of the last 5 years or something like that, we've been talking about this issue within the alternative space, right? And when redemptions come in, and whether or not people are going to be able to get their funds out, and how pervasive this has become in the retail space and the wirehouses and things like that. And so this is an area that we've been talking about a lot, and just happy to be here and able to participate in the panel.
Yeah, a lot of us have firsthand experience in many different ways around this. And I know Joe and I in particular, when we were at our previous firm, we dealt with some of these on the private real estate side. And we saw some gating and things that happened over there. So we've seen this in real time, not just back in 2022, but back in 2015. And obviously, I think a lot of us saw it throughout the financial crisis. So we see what's capable and what's possible within this space. And right now, I think you're seeing billions in redemptions that are coming through, and that's happening to all the private asset managers. And what we're seeing in the biggest topic that's really hitting us is gating. And essentially, the redemptions are far greater than what a lot of the funds can actually meet. And it's not that I don't want to say meet it, they have rules within these funds that, especially interval funds, where they only have to meet maybe 2% redemptions a month, or in some cases 5% per quarter. So there's more than 5% of those redemptions coming through. So the funds are saying, hey, listen, we don't have to meet all these redemption gates. And there's a reason for that. The reason is because the securities they have are illiquid, and they couldn't go liquidate all of those securities that are in there. And as a result, we're seeing a lot of news that's coming out about the prices that these securities are trading at. Particularly, I think Blue Owl is one of those names where they've been moving securities around with certain subsidiaries and talking about how they're moving them close to par. But I wanted to talk about this, Laks. I know there are a lot of forensic research in this space. What's kind of your take on these par prices, and do you believe that they should be going at par, or is there something else going on here as we start to look at this?
Thank you, Todd. I'm going to take a step back and address this in a different manner. When investors are talking about private credit, because there are a lot of redemptions going on, what they are forgetting is how banks are structurally embedded in private credit performance in ways that do not show up in any single balance sheet line item. And that's where our focus mainly is, because investors most of them think that the banks has nothing to do with the private credit. When private credit is going through redemptions, the banks feel it. And that's what I wanted to address. And also, another topic I wanted to share is that private credit default rate, if you look at it, it's given as roughly 1 or 2%, but in technicality, Fitch tracks private credit default rates two ways, and it's close to north of 5.8%. I know it didn't answer your question directly, but I wanted to address this first, if that's okay.
Yeah, no, that's fine, because I think that plays into what we're talking about, right? The default rates and what's truly happening here, and topics around payment in kind are, I think, a really important topic. Because this does give you reminders of the financial crisis for how they were pricing mortgage backs.
Yeah.
And sorry, can we take a step back? I think it would be good for the audience to get a little bit of a history lesson on how private credit has evolved in the last several years, because there's been tremendous growth. It's not exactly clear, I think, to most people as to exactly why private credit has gotten to be as big of a force in markets.
Yeah, Michael, go ahead. I mean, do you want to talk? You want to talk about that? And
yeah, no, I feel like Locke might have some really interesting context of that. I put out several charts that show sort of the growth of private credit over time. I mean, I think arguably, especially post GFC, there's been interest in investing in things that may not be marked to market. Right? I mean, one of the dynamics of private credit, obviously, is that there's no real time market to really know what it's priced off of, which you can argue provides a degree of comfort to investors because the illusion of stability is probably the number one reason why most people like to invest in something, right? The illusion of stability, which if you're not priced real time, you're going to get. But I don't know, Locke, I mean, from your perspective, why is it, what's driven a lot of the growth the last several years in the space?
I think investors are searching for yield, right? And this has been sold as giving people yield, giving people equity-like returns, but having the stability of bonds, which I don't know is such a good thing over the last 2 years, but has certainly been something that they've been selling. So we have seen, I think we're over something like $3.5 trillion or something like that in AUM when we look at private credit in this space, and that's growing from maybe just 200 billion or so back in, I want to say in 2010, right after the financial crisis. So the whole shadow banking system exploded in this, and people were searching for yield. And so this has been sold to a lot of investors as, yield income with a lot of stability around it. And we really haven't seen a major stress or credit event since the financial crisis. We've seen little blips on the radar, but we really haven't seen anything that stressed it and quite at the same magnitude. I also think as this area has exploded, they've had to start searching for other places to invest that money. So private credit has kind of had to chase different investments. Laks, have you guys done some work on this and talked about kind of the things that they're looking at and chasing and what they're investing in today?
So private credit, there were a couple of things I wanted to address first before I talk about how private credit is a lot intertwined with consumer credit these days. And one thing is backing to what worries people. And I think that's why we are here to talk about is that private credit by nature is opaque and it's by design. And they are initially, I mean, other panelists can push back, but they are initially designed for the institutional crowd. Here's what worries people as the redemption we've been seeing since last year is that retail investors start asking for their money back, right? And institution investors have the bandwidth to take some hit if there are some downside. Institution investors are equipped to do that, whereas private retail investors, they get afraid. The second there is something wrong with it, they get afraid. They want the money back, but that's not how it works. You have the redemptions. It's not like private credit is going around and lying to people. It's everything defined clearly in their prospectus. And what we have been saying is it's technically the job of financial advisors who are advising these retail investors about investing or allocating to private credit. They should be aware, they should be able to read the prospectus, understand the risk, and then advise for or against in investing in the private credit. And we have been very vocal about that. We don't think many financial advisors are doing what they are supposed to be doing. And private credit has 10.7% or a good amount of yield to attract retail investor crowd. Okay. And that's what attracting them. But retail investors, for instance, there was private credit, H-Lend, I believe. The initial investments to get in is $2,000. So $2,000 or $2,500. So they make it so easy for people to invest. And there is technically nothing wrong with it, but it is important for the retail investor crowd or anybody who's advising the retail investors to understand the risk that's involved, to understand that private credit is opaque. It's not traded in public, so mark to market is kind of And then, there are they are illiquid, and these are the knowledge that needs to be shared with the retail investors, which we think was not properly shared.
What do we think the reason is here in many cases for retail investors getting so much more involved in this? For example, right? Do you guys have some theories around that, Michael? I know you're always kind of dealing with retail advisors and institutional investors as well. Do you have any thoughts about that? Like, I've had some theories myself. They need liquidity, but also to retail investors, I think, have been asking for this as well. So, are we just giving them what they want?
Yeah, look, I think first of all, it's private credit sounds exclusive just in its term, right? So people like the idea of getting access to something that's private. I mean, there's a marketing aspect to this as well. And by the way, I just quickly pulled up and created this chart using AI and fact checking. This is a chart that looks at the growth of private credit going back to our earlier point, just to give you the context, folks. And then obviously the expectations, which we'll see how that works out. But I think in general, you can argue there have been more interesting opportunities in the private credit and private equity space. I mean, you've seen in general a trend towards fewer and fewer companies going public, period, right? And retail sees that, right? A lot of the companies that have gotten these multi-billion-dollar valuations are doing it from the private side. So it makes sense that retail wants access to it. It makes sense that advisors want to say that they have access to it. I was kind of smiling a little bit when Locke was saying about advisors reading prospectus. I've been in business for a long time. I can tell you most advisors are not reading prospectus. Unfortunately, that's the reality, even though they are fiduciaries. You got to be careful, folks, with whoever you trust on whoever's allocating on your behalf, because advisors will do the same thing as everybody else. They'll look at a yield, they'll assume it's money good, they'll look at a brand, and that's good enough for them. Real due diligence, unfortunately, is lacking in a lot of aspects.
If I could just add one thing there, Michael, they're looking at the yield. They're looking at, the diversification benefit, right? Because it's not being marked, and now all of a sudden you're marketing this uncorrelated asset that's going to diversify your portfolio. But let's call it what it is, right? There's a mismatch of incentives that are involved in these things, right? When you're in the wirehouses, advisors look at these as a real easy way to clip a commission. And when you're bosses, right? The branch managers and all these other people are looking at you and you need to hit metrics every single year, right? Okay, yeah, I'll do the private credit fund where I can, if I'm charging someone a percent on AUM that I'm actually managing, but if I do this private credit deal, now I get 2%, possibly I get some trail, things like that. It's a misalignment of the incentive structure. And I think when you do that and then you put these other things together, okay, yeah, we're showing a 10+% return. We're showing an uncorrelated asset. It's actually a portfolio diversifier. This is going to make things better for you guys. Now, all of a sudden, it's like, yeah, okay, why am I not going to be in it? And then you layer in the exclusivity aspect that you just mentioned. A retail investor is going to be like, yeah, I mean, what could go wrong here? This sounds amazing.
Right. And I'll take it a step further. And unfortunately, I have to hop out, so you guys will get to enjoy the webinar without me that are attending. It's a bigger sort of dynamic. I mean, Todd hit it. It's yield, right? What's happened in the private credit space is what's happened also in the public ETF space when it comes to these cover call types of funds, these single stock ETFs that are generating 50, 60, 70% yield. Retail gravitates towards this because they see the shiny object. They don't understand the strategies. They don't understand. All they see is that number. And it works until it doesn't, right? Yeah. I mean, that's the reality. And unfortunately, it's like this is more of a human behavioral aspect. I think that human beings are very bad at understanding small sample bias. So just because something worked over the last 2 years doesn't mean that that's an example of how it should work going forward, right? And this is where I think people get into trouble. 2 years is nothing in the grand scheme of large cycles, right? But it can result in people misallocating for multiple years as a result of those last 2 years. So I'm going to step out, folks, but please stick around for everybody here and we'll reach out.
Yeah, thank you, Michael. And Michael's segue there is actually a really interesting conversation point because we have two things
You're welcome.
to talk about right there, right? When we look at it, there's two things that are coming up, the NAV and delayed reporting, but there's also the small sample size, which is very interesting because people are talking about what happened in previous events like 2007, the financial crisis, and other periods of quote unquote stress. And, what happened to private credit defaults, what happened to recovery rates and things of that nature. But there's an argument to be said that the private credit market of today is not like the private credit market of previous periods because of the amount of growth, the underlying investments, and just the reach within that market. And so I think that is a part of the conversation that has to be happening. I think that translates into some of this correlation as well, and which we can touch on in separate segments. But Laks, do you have any comments or thoughts about that, right? The private credit market today and what the composition is compared to where we've been previously due to this growth?
Yes, definitely. But first, I wanted to thank Joe for saying there is a mismatch in compensation for financial advisors because that is true. I mean, first, where is the fiduciary duty? Second, they're not reading the prospectus. Third, Michael is 100% right. They look at the yields and say, okay, I wanted to invest. And fourth, they are getting kickbacks, like Joe said. And all of these are setting up for, like Michael said, everything works until it doesn't. And one of the problem is, and I keep sharing this, as much as we do not like how opaque private credit is, what is critical to understand is after 2008, because of too much regulations, the shadow banking began, and it provided access to businesses and consumers who otherwise would not get access to credit. That's how they started. And by true to their name, they have been in shadows and nothing happened because everything was working fine. Banks over the years started funding private credit through non-banking financial institution allocations, right? Roughly 23% of that NBFI, non-banking financial institution allocation, goes to private credit. What they do with it, we have no idea. At least, I don't. And then private credit in turn takes and allocates to multiple businesses, BDCs, and one of them is buy now, pay later. They enter into forward flow agreements with a firm, PayPal, and other BNPL firms. It's kind of feeding them, and they in turn sell the loans back to the private credit firms. So the point I'm getting is private credit as an asset class is not going to die anytime soon. What we are seeing that's happening is a bifurcation. Institutional money is still flowing into private credit. Retail money is starting to flow out, because they feel blindsided by not understanding everything in entirety. Blue Owl just sold 600 million of loans from its retail fund and transferred it to institutional buyers, including CalPERS at 99.7 cents or so on a dollar. So there is a structural shift, if you will, happening inside the private credit where they are moving from retail to institutional. And with respect to whether it's 2007, 2008 style, what we are watching is not a 2008 style event per se. It's going to be worse because the situations in 2008 is a lot different than what it is now. It is going to be persistent, dragging, and it's going to be harder to read, whether it's private credit, private equity, which makes this cycle more dangerous than 2008, not less. Back to you.
Yeah, I think those are great points. Joe, go ahead.
So I think a very interesting point that you brought up there was the entanglement of the actual banks, the regulated entities, right? I don't think people are quite aware. I mean, it's something that I've learned about, in the past, I don't know, 6 months or something like that. But you want to kind of follow a really interesting thread, start digging in on things like warehouse financing and stuff like that. Like that is an entire business line that exists in many of the biggest banks where they are just underwriting lines of credit to the asset managers so that the asset managers can then fund these funds. And then, as you said, right, they package things up, they sell the loans, and then they pay off the line of credit. And what goes on is this is a repeating cycle that goes on and on and on and on again. So you're taking this single dollar and turning it into, how many different investment products throughout the entire street. And one area where Todd and I for a long time have gone back and forth on, do we think this has that systemic level of a 2007, 2008? And I wasn't really sure, but the more I've read up on warehouse financing and how all of this works, there is a definite component where you now have these linkages between the regulated banks and the asset managers. And it creates a real problem because now, those credit lines, we've talked a little bit, somebody mentioned payment in kind and things like that, right? Oftentimes, when these redemptions come in, if there's available liquidity on the credit line, before they sell anything, they're going to draw the credit line to fund a redemption. And this is where things just start to really become problematic, right? Because now you're fully extended, so you're driving up your leverage ratios on the fund before you've even sold anything to start funding redemptions. So, and I just think it's a really important point that I don't think enough people have an understanding that, these private and equity, private credit funds, you ask yourself, where do they keep finding this money? How do they keep launching new fund after new fund after new fund after new fund? And when you start to understand the warehouse financing aspects of things, it starts to make a lot more sense of how they're able to continuously bring these products to market. It's really fascinating to see how it all works. I pray that it's not a systemic situation ever. Having already lived through 2008, I don't really feel like I need to go through another one of those. But unfortunately, the more I read, the less convinced I am.
One of the things that's interesting is that we see the private credit funds coming out and pushing back against a lot of this, obviously, right? It's survival for them. And I think that, they're trying to feed as much positive information to FAs that are out there. And I think as FAs, right, it's important they read through the prospectus, but I think it's also difficult to understand where you're getting good information from, because your firm that you may work for may be feeding you down information or filtering what information you get or how you get that information, because obviously there's incentives that are associated with it. So as the individual FA and conveying that to the client, I think can sometimes be a little difficult to work through. And I think, though, one of the things to address head on is that some of these private credit institutions have talked about, okay, the credit standards of the underlying loans and everything are good and all that. But there's an argument out there, too, that if these redemptions keep coming through and you have forced liquidators, and then you have other institutional funds that are sitting on the other side, knowing that there's forced liquidations coming, that could cause markdowns as credit lines dry up, as you sell off your best, your best loans first, and then you're left with basically stuff that's not, quite as liquid or quite as attractive to the street that wants to buy. So what's kind of that feedback loop that happens there? Because the argument is that even if the credit quality is good, if you have a liquidity situation and you need to meet redemptions, what does that do to the prices of those loans? And what's that implication for the people that continue to hold the fund itself, right? The people who hang on and aren't, meeting those redemptions. What happens there? So I'm interested in both Joe and Laks, your take on that.
So I think importantly, what you're talking about is when the redemptions come in and you don't have a situation where you can draw on a credit line to immediately pay the redemption, right? Or the redemption's larger than that amount that's outstanding. That upper echelon of credits is going to be your most liquid, easiest to sell loans, right? So they're going to sell that stuff first to fund the redemption. What you're then left with is just inherently going to be a lower credit quality, right? And the more this goes on and the longer this lasts, that continues and continues and continues. And now when you start to think about what I'm talking about with like these warehouse financing agreements and these lines of credit, suddenly you had a loan book that, was a certain credit quality. Now it's vastly deteriorated. Now you can't access as much capital anymore, right? And so these things become like a self-perpetuating feedback loop. And unfortunately, if you're the one that's holding throughout, you're going to be stuck with the worst credits, the worst credit quality, the worst loans, and you're potentially going to wind up taking serious markdowns on what the holdings are.
Laks, do you have any take on that?
Yes, I just wanted to add one thing. The negative feedback loop, I I don't think it's just on the fund level. It also runs through the banks. Sorry, there is like some lawnmower annoying me. I hope you can still hear me. But JP Morgan is already marking down the software loans held in private credit clients' financing portfolios. Those marks reduce JP Morgan's lending capacity in turn to the same funds. So Western Alliance also took, I believe, roughly $125 million charge-off on a loan tied to Jefferies special purpose vehicles. And it's this negative loop requires like the stress can move through the system for a long time. Whether it does it immediately or through a lag is for us to see. But it's private credit funds are so intertwined with the banks, with the BNPL, with commercial real estate. It is hard to see where it goes. And that's what makes it very concerning. But you will start seeing pockets of implosion everywhere, and the source will always be in one form or the other, a private credit.
People have mentioned that, and you mentioned implosion there. People talk about credit spreads being really tight. And my background's in fixed income and credit, and I always like to watch credit spreads. But it's interesting to think that private credit may not, and what's happening there may not fully be reflected in what's happening in traditional options adjusted high yield credit spreads. Joe, I know we talked about that. So do you want to touch on that a little bit and, go through and Laks any insight you have there?
Yeah, well, this is something you and I have talked about a lot. Because we utilize credit spreads as an indicator, to really pick up on periods of stress in the market. And at various times, you and I have both posed the question of, do these indicators work with the same sort of efficacy that they used to? Because those traditional high yield borrowers, they found a new source of funding, and they don't need to tap into the high yield markets. They can do it through a private credit offering, right? And so now when you're looking at credit spreads, are they, is the high yield fully reflective of the risk that's in the system when so much of the system has now gone outside of public markets? I'm not sure. I still believe credit spreads as an indicator work. I just don't know if they work to the same degree necessarily that they might have in the last cycle. And I think Laks, like that was a very great point about the feedback loop, because I mean, I can remember going back to the financial crisis, and one of the things that started to really put pressure on the banks was when certain, due to the counterparty risk, right? Certain banks were requiring additional collateral. And when you couldn't make the collateral call, now all of a sudden you were getting called on your loans and things like that. And it just became a complete disaster, and it spread a lot faster than I think anyone anticipated. And this could potentially be something that's very similar to that, as you said, with the feedback loop.
Yeah, no, certainly. Laks, any thoughts on that?
Sorry, I just wanted to share to all the listeners, whether you're sophisticated investors or retail investors, just don't blindly trust anyone asking you to put money on something. Just read the prospectus, ask questions. Sometimes questions can be uncomfortable because, you never know which financial advisors are getting the kickback. In theory, there should not be any kickbacks associated with selling a product, but in reality, it's very complicated. Just don't invest in something that you do not understand. Rule of thumb, if I can't explain it to someone in simple terms, then it's complicated. Then you have to read the all prospectus. So please be cautious about where you're investing.
I think that raises an interesting thing about questions that whether we're dealing with regular investors or we're dealing with advisors that may be on this call. What questions should they be asking of the private credit funds that they're invested in or they have their clients invested in right now? If from that perspective, I know obviously there's a lot that we can do on the due diligence side, but let's say we're already invested in that private credit fund. What should they be looking at? Like, for example, questions I could think about are like, what percentage of the portfolio has been sold over the last 2 or 3 quarters to meet redemptions, right? Where's the source of liquidity coming from would be a big one that we look at with a lot of that. I spoke about this in an article that I published as well, but how many quarters deep are redemption queues right now? Like, what percentage of the fund is that actually, reflecting, and kind of what's the estimated wait time? Because funds can be a little different, and we're seeing some of them shift their redemption policies. Sometimes they're saying, okay, we'll redeem a little more than 5%. And then again, there's funds. I think, I don't want to go into any names because I need to pull up all the research on it, but some are just saying, hey, listen, we're going to stop meeting redemption requests like altogether. So those kinds of things are in there as well. But Joe and Laks, do you have any questions that you think are really important that people should be asking if they're invested in private credit right now, advisors or individual clients?
Where the investment goes are they investing in BNPLs? Are you investing in where the money that the fund has is invested in? Like, try to see this. So try to connect the dots where the money is going. That is one important question. The second one is, if ask for redemption, say 6 months from now, I wanted to redeem, would I get the money back? And if the answer is, because it was one fund, I can't remember the name of the fund, they got redemption request, and the way they dealt with it was they gave the money back. So if there was like a 2% redemption request, they just gave the money back. And this gave a confidence to the investors to say, oh, they have nothing. They are investing in liquid assets, not illiquid assets. So I can take money whenever I want to. So that fund actually saw more money flowing into them. So trying to be as transparent as you can with the investors. Doesn't matter if the investors are investing 10 million or $10,000. So I think that transparency is very critical for private credit if they want to regain their credibility. Right now, private credit has a credibility problem. So it's more like what questions I would ask. It's more like they have to be transparent with their investors, with whatever questions coming at them.
Yeah, certainly. What about yourself, Joe?
I would say, there is still money coming into these things, right? So the net cash flow, let's say, right? What's coming in versus what's being redeemed. That'll give you an idea of, are they able to, almost kind of meet these redemptions with new inflows, right? That's an area that we haven't necessarily talked about that could continue to prolong this longer, where they're able to fund these just based on new money coming into these vehicles. Another area that I would look at, right, is how much of the fund has relied on payment in kind, right? Because payment in kind is just all you're doing is just adding more leverage to the system, right? You're adding more leverage to the fund rather than making an interest payment, rather than defaulting. You're just issuing more and taking on more debt, more interest, so on and so forth.
Yeah, it's interesting you mentioned that. We didn't even dig into it, and I don't want to drag everyone too much longer here, because we could do a webinar a day on this probably if we really wanted to dig deep. And I think
Unpick.
I think we're going to come back with a lot of this, but payment in kind is something everyone should pay attention to, and payment in kind levels across these types of loans have really spiked. I've seen some stats where they've almost doubled. Over the past couple of years. And so this is something to really keep in mind, because people use payment in kind when cash flows become an issue. So it's just a stat to pay attention to right now. Again, I think we're going to try to come back with, dive deeper into certain areas of this stuff, because we could talk 45 minutes about just this topic alone.
Yeah.
And go into what it means. So we'll circle back with everyone on all those kinds of things. But Laks, I know you have done some work here in this space too. So if there's anything you want to add, I want to give you a chance here, and we'll kind of work on closing out a little bit.
Yeah, like you said, it will take a whole separate seminar to cover this, but payment in kind captures the stress that is not technically reflected in default numbers, right? A borrower running out of cash can quietly amend their loan to pay in kind instead of defaulting. And it's just not happening in private credit. It's happening across the board in auto lending everywhere. So what it does is the loans are technically stays as performing and current. The lender stops receiving cash, I believe. So the Lincoln International, I think it's IB, calls this a shadow default rate. So their bad pick figure was roughly around 6.4% in Q4 2025, up from 2.5% in 2021. So Fitch recently issued an analysis that it said the broader default number captures some of this, but Lincoln's lens captures what's happening quietly. And these are the things you don't see getting reported in the mainstream media, right? So the pick is where everybody needs to focus on.
Yeah.
Back to Todd.
Yeah, they don't want to talk about this too much. So I know we've gone over a little bit. I appreciate everyone being patient, and we tried to talk about some of the questions as you guys and girls have pushed them through here. So I just want to give it a chance. Joe, do you have some closing thoughts you want to leave everyone with as we look at this? And we'll certainly do more of this, everyone.
Yeah. So, just as we've seen things come up in the queue here and whatnot, I just want to be, we're not all sitting here saying every advisor on earth is, has nefarious things going on, that they're trying to just, sell these things to clients and they don't really care what the outcomes are. I tend to believe that a lot of advisors are doing the proper due diligence and do have the proper understanding prior to putting their clients into this. But what I do know from a lot of the conversations that I've had over the past, 5 years, maybe longer, I think the incentive structure is just, it's out of whack, and it's very, very similar to what went on in the mid 2000s prior to the financial crisis. Back then you had mortgage lenders that were incentivized to continue to push out mortgages, and so they gave everybody who had great credit quality, great credit. They all got a mortgage, and then what did you do when you ran out of customers? You lowered the standards and expanded the addressable market. And they were incentivized, the banks were incentivized to take all that stuff up, bundle it up and sell it, and then create another product to layer on top of that, and again and again and again. And we all know how that went. And I think I've had enough conversations with various issuers and things like that where people are telling me these are fully, they're because we don't mark to market, it's an uncorrelated asset. It's a portfolio diversifier. Just because you're not marking every single day doesn't mean that the risk that's in the portfolio just magically disappears, right? So I just think, again, though, that's somebody who's incentivized to say that and sell those products, right? So I completely get it. Like if you're working for an issuer, yeah, like you want to sell these things because your livelihood depends on it. And so I just think it's really just a misalignment of the incentive structure. I don't think any one of us is sitting here telling people, hey, all advisors are terrible people trying to steal your money. But I think like the broader system, the advisor benefits, the fund issuer benefits, the banks benefit through these lending agreements that they have with the fund issuers and so on and so forth. So I just think that, that really at the end of the day is in my mind is kind of the root of the problem. It's just a mismatch of incentives.
Yeah. And I mean, that's systematic. That's not just even with private credit. That's with so many different things that we see within the industry, and not just finance, right? There's a lot of different industries that we can start to have this conversation about. But it is just something to be aware of, right? How are people being compensated? And I think I wrote a piece about that a while back is, if you are being pitched anything or you are being suggested to be put in anything, understanding the compensation structure for the person positioning that with you is really an important thing so you can make a balanced opinion about, what may be incentivizing that person to make that recommendation, right? And that's just a really important part of this whole thing. All right, so I want to thank everybody. I really appreciate it. Like I said, there's a whole lot of topics we could have talked about. We could have been doing this for an hour, do this every day. And I think we're all going to come back to you and address more topics in detail and take some feedback. So please, any of you that are on this, reach out to us, let us know. We'll also send you a follow-up email and reach out to you so that you get our social media handles and you get anywhere you want to follow our research and see what's going on. Because I know that like Laks and Michael and myself were very active across different publication platforms and particularly on X and stuff. And it's a great way to stay informed for what's going on and what our opinions are and what we're looking at. So I really encourage you all to do that. And we'll share that with everybody. So thank you very much.
Thank you, Todd. Thank you, Joe. Thank you, everyone.
Thank you, everyone.